Good afternoon and welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we're going to talk about large cap stock. What is large cap stock? Well, large cap is an abbreviation for market capitalization, and it generally represents companies that are over $10 million in valuation. And the way that's calculated is we take the number of shares that are outstanding times the price of those shares. That's what large cap stock is. When we look at the stock market, as most people view it, people look at the stock market as being the S&P 500, which is the top 500 large cap stocks in the country. And those are probably the biggest representation, it is the biggest representation of the US market, but it's not all that's in the US market. And so when we talk about large cap stock, or when people talk about the market, and is the market going to be down or up or sideways, they're talking about this particular asset class, large cap, which only represents a small portion of your portfolio. If you take a look at it, and if you're in any of even our most aggressive portfolios, you'll see that large cap is only a sliver of it, but it's an important sliver. And so we wanted to talk about that today. Just to go over a little bit further, large cap companies tend to be very transparent. There's a lot of information about them. They sometimes are dividend payers, and when they are dividend payers, they're more usually considered value companies versus growth companies, and that's another element of how you select a large cap representation. And there's also the idea of how much of the different sectors are you going to be exposed to, and what types of other features you want to take into account. So it's not just like invest in large cap. There are a lot of choices that can be made around how are you going to invest in large cap. And a matter of fact, there's over 3,000, something like 3,500 mutual funds / ETFs that represent large cap as well.
In one category.
In one category, which is quite a lot of different choices. So we have some choices that we pick.
Yeah, I want to make a couple points there. First of all, you mentioned dividends. Dividends are an important part of the long-term return of the stock market. Historically, dividends have represented about 60% of the return of large stocks historically. So dividends are important. And secondly, the way you value actually any kind of stock, something called the dividend discount model. And so what you do is you discount using a discount rate all of the projected future dividends, and that should actually equal the current value of the stock, which is interesting. That's from an academic standpoint. Doesn't always work that way, but that's how you can tell whether the value really exists in that stock or not.
So Steve, since you went in that direction, how then do you value a company that doesn't pay out stock? Because a lot of the top growth stocks don't pay out any kind of dividend.
That's correct. And so they use a different discount model for those. They actually look at future earnings rather than the dividends, believe it or not.
And what if there are no future, there's no real evidence of what the future earnings will be?
That's correct. And so therefore, theoretically, it has zero value, and Amazon was a stock that looked like that. No one ever, there were times when, a number of years when I don't think anybody were sure when they were going to start earning money. And so the market was valuing that stock all on future, I would say, anticipation of how they were going to perform rather than the reality of them actually providing income to shareholders.
Right, and there are some ways. I don't want to take away from the fact that there are ways of being able to project what's in a company's pipeline in terms of producing future cash flow streams.
Yep.
It's a whole science and a whole analysis on how to do that. But suffice it to say, it's also
CFA and me coming out, okay?
But it still is speculation. It's still not based upon anything other than what we think is going to happen. And so that's always difficult. While we're talking about this, which I wasn't necessarily going to go in this direction, but I do want to mention that the price of a stock today is priced based upon everything that we know about that company. It's based upon what we think is going to happen. So for folks that come in and they say, oh, I think we should invest in XYZ company because I know something special. Well, if you're not in that boardroom, you probably don't know something special, and it probably has already been baked into the cake of that price. So just something to keep in mind when we try to outguess the market.
Theoretically, that's efficient markets. The price should be based on all publicly available information. That's the theory.
So of course, we have these 3,500 different funds we could invest in. We have all these different stocks we can invest in. How do we make the choice for you? As fiduciaries, as people that want to make the best choice for you, how do we do that? We try to flush out a lot of the noise and to really boil it down to the best, most diverse exposure. And so currently we're holding about I think it's 6 different funds that represent the large cap space. And each one of them have a different kind of perspective in the way they're investing. And we have done the analysis. Steve's done the tedious analysis using his Bloomberg terminals on making sure that all the underlying investments that represent these 6 funds are not overlapping each other. In other words, we are not holding duplicate funds, which oftentimes we'll see people will come in and they'll say, I'm diversified. I have 6 American funds. Well, guess what? Most of the American funds all are holding the same thing. When we do the overlap analysis, we find out you're just holding the exact same positioning.
Yeah, and there's a reason why we have these different holdings. They're clearly different strategies. They're all of them are, except for 1 or 2, are index type funds, but they clearly are different types of index funds.
And so maybe we should start the second to last fund, which we probably should have listed first, is a SPY, SPY. Some of you know that fund. It is a fund that mimics and mirrors the S&P 500, and so you can get exposure to that fund fairly easily because it's just a basket of all of the 500 top largest companies in the country, and there's no judgment in terms of what comes in and what goes out. You'll notice all the way to the right-hand side of this graph shows the expense ratios, and you can see that the expense ratio is 0.09, or what they use in the vernacular of our industry, a lot of times they'll say 9 basis points, which is real cheap. So we can get exposure just to the US large cap stock market, S&P 500, very inexpensively for you. And so we have done that. And last year, this particular fund performed right consistent with the S&P 500. No surprise, 18% return, no surprise there. What you'll notice though is a lot of our other choices did not necessarily perform as well last year. Although if you start looking across this graph, you'll see that the return year to date, which means just this current month, just January, the S&P 500 fund did not do as well. The other funds actually did much better. And then if we even go a little bit further and look at the 4th quarter, you can see the same dynamic. The other funds did much better than the S&P 500. And then when we come to a 5-year period, okay, 5-year, they're more aligned with each other. But it's an interesting situation because this past 5 years have been a little bit different than the prior 5 years, and even historically. And that's when we start talking about value versus growth, which we're actually going to save for a separate video because we think that that's such an important conversation just by itself.
Yeah, and I want to mention, by the way, that while SPY was the second best performing version of large cap stocks over the last 5 years, That's principally because it beat the other ones last year. Yeah, it did. But what's happening now is those other categories, because they're starting to outperform this year, most likely they're going to catch up, and they could potentially exceed the S&P 500. For example, DSEEX, which is one uh, uh, fund we hold, it actually is based on something called the Shiller Cape, which I think that's just for another video what that means. What they do is they rotate among S&P 500 sectors based on evaluation of the sector. And it's done quite well over 5 years. It's lagging this year, but it's done quite well over five. But also the other couple of methods that we use to index on the S&P.
Can we just stop there, Steve?
Yeah, sure.
I just wanted to say something
Yeah.
about the Shiller fund. You'll notice, so this fund, and there's a whole nother conversation between active versus passive management. This is the one fund out of this entire group that, well, no, I should say the last one is as well, but it's one of the active choices, more active choices.
I call it semi.
Okay,
And what I mean by that is that it's based on a formula, not so much the whim of a manager. So they're not stock pickers as much as they base what sectors of the S&P they hold based on a formula.
and mathematics and so forth. But,
Yep.
but there is a little bit more active thought that goes into that versus
Yep.
just being an index.
Definitely.
And because of that, you'll notice that the expense ratio is higher. Expense ratio is probably on the higher side of a lot of our choices. And we're very, very careful in spending your money. When we hire a manager, we want to know if in fact you are going to spend a little bit more money on holding that fund, are they actually producing value there? And there's a whole nother analysis that we do, and we look at something called alpha, alpha and uh, oh, I can't, it flew out of my head. Uh,
Sharpe ratio and is Jensen's alpha
and well, what Petagisto and Kramer also developed, active share is called.
active share.
They started, they created another metric in 2009. They're two PhD scientists in understanding, in fact, how active, if somebody is performing actively, are they really, really doing something that's unique and different, and are you getting value from that? So there's a bunch of different ways that we look at when we start picking more active selections. How are they really adding to your portfolio? So we want to make sure that each one of these are incrementally adding to your portfolio.
I want to mention something, and it's a common it's a point of confusion I see with people. They look at the expense ratio, then they look at the return of a fund or an ETF, and they think that you should reduce that return by the expense ratio. Those returns are always shown already net of the expense ratio. So, for example, the holding on top is averaged almost 18% over 5 years. That even though it has a higher expense ratio, it did beat the SPY by that difference when you net out the expense ratios.
And there it's earning its
Yep.
the cost of having spent that.
Which is why we hold it.
Yes. So you mentioned the that first one. Do you want to talk about the equal weight, Steve?
Sure. And so the SPY, it follows the standard S&P 500 index, which is weighted a certain way. It's weighted by the size of a company effectively. The equally weighted index. So in other words, by the way, I want to back up. The SPY can be overweighted to a company if it's much larger than the others. Its representation in the stock market. The equally weighted index, they weighted by basically taking the 500 stocks and dividing it equally in the fund. So in other words, it's 0.2% of each stock in the fund. And so it's equally weighted, and they rebalance quarterly actually to maintain that 0.2% representation of each stock. And so we think, and it's based on academic studies as well, long term, that the equal weight does outperform the capitalization weighted. There may be periods of time when it'll underperform. We saw that, although now we're starting to see that it's starting to catch up again. But we think long term it'll outperform the standard capitalization weighted index, and it's also less subject to some of the distortions that arise within the S&P index. We have 4 or 5 stocks very heavily weighted in the index, and they were actually overrepresented within the index.
Those were the top 5 stocks that a lot of people are familiar with, like Apple and Microsoft, Google,
Mhm.
Alphabet, Netflix. They were actually making up a very, very large portion of the S&P 500 in 2020, and they drove a lot of the growth. But that meant that your exposure was really towards those 6 companies. And we know that over the long run, creating too much exposure in any individual company is never good for your portfolio. You're not adequately compensated for that level of exposure because you're taking on all the business risk of that company. So that's why the equal weighted gives you much more diversification. And again, diversification is the name of the game.
And by the way, that risk that's unique to a company, we have a really nice term for that. It's called idiosyncratic. And I pronounced it too.
You did. Very good. And then the revenue fund, Steve.
Yeah, and so the revenue is actually another different way to index. They actually index based on the total revenue of a company. So in other words, they'll take all the companies and they'll say, all right, your revenue is 6% of the entire S&P index. So you're going to be 6% of this index is going to be in that company. So they base it on revenue. And there's a lot of theories and a lot of views that that's a more valid representation of the true value of a company, especially in the long run. And so overall, that index has also done quite well in relation to the S&P 500. And so last year it did lag, but now we're starting to see that, as you can see in the fourth quarter last year and now this year, it's starting to come back and actually perform quite strongly.
And so we have the capitalization weighted with the S&P, we have the equal weighted, we have the revenue weighted, we have the Schiller index, which kind of rotates things. And then we also have one that's just focused on dividends as well, right? Looking for those companies that are truly value companies and are paying dividends. I don't know if you have anything you want to say about them.
Yeah, and his rationale for that is that we know historically dividends have represented 60% of the return of the S&P. And frankly, as an investor, you can count on dividends a lot more than you can count on capital appreciation. And so dividends are much more of a sure thing if you're an investor than capital appreciation. Because capital appreciation can come from a couple of different ways. It can come from actually the fact that a company grew, but it can also come from the fact that the price to earnings ratio expanded. In other words, the PE ratio went from 15 to 20. And you can give that back, by the way. If you can see price to earnings ratio contraction. And back in the 70s, a lot of people probably aren't old enough to remember, at one point, the price to earnings ratio on the S&P was down to about 6. Now it's, I think, somewhat over 20 or maybe around 20.
And you can notice with that particular fund, and it's the third from the bottom, it says Spider S&P Dividend ETF. You can see that the dividend is significantly higher than all the other dividends. So it's really focused on paying that yield of 2.75%.
Which is quite good these days.
Absolutely. Yeah, yeah. So another way that we're creating more cash flow, whether we reinvest it or whether we use it to pay you out the amount of money that you need to live off of, however we're trying to create it. And then the other last true diversified fund, and this is very much another angle to the idea of diversification within the large cap sector, is the Stone Ridge. Also in iShare. So whenever you see I, you know that we're flushing out, we're getting the opportunity, because we're institutional investors and you're invested on the institutional side at TD Ameritrade, you know that we're able to get these funds that most retail people cannot get, but they have reduced expense ratios and no sales loads. So any marketing costs associated with these funds are stripped out.
Yep.
Do you want to say anything about that fund, Steve?
Yeah, and we were actually in the process of reevaluating this fund right now, but their approach is somewhat unique. They invest in an S&P 500 index, and they also use options to try to limit the downside on that index. They use call options and put options. And that's just for another, I would say, video that start to explain what call and put options are.
So as you can see, we're trying to address all the nuances of what we're thinking about in each different area. We've now just talked about just one little asset class out of the other, all the asset classes. And even there, we're not fully explaining the even strategies in terms of value and growth and all the other things. So there are a lot of things that we're considering as we're putting together your portfolio and trying to make sure that every time we add something in, it has a purpose and a reason, and whether it's to bring return or reduce risk or what have you. And we're going to just keep on doing this. Hopefully we're going to create a library of these types of videos so you can go back to them and look at them. The more you understand what we're doing and why we're doing it, the more comfortable and the greater peace of mind you'll have. So that's why we're doing this.
Yep.
So again, of course, we're always open to talking about your individual situation and your individual portfolio. We're talking more in general terms right now, but please let us know. We always love to hear from you.
Yep. Goodbye.